So Mike asked, after entering the Married Put, I'm going to go back to the June series, and the 22.5, it was 60 cents. Now, I'm simulating when it was at 22.10 if we had sold the May call for 60 cents, but this is what the position would look like. Okay, and just like a calendar spread, think about it, that's what this is. Instead of a long call, which takes 100% of risk of what you invested in that leap call, the poor man's covered call. You know, if the stock falls, you could lose 70 to 80% of what you invested in that call. But here you've got a stock and a put combination, which controlled the risk down to only 3.8%. And now you're selling a call against it at 22.50. Remember, my cost basis is 22.79. Not a lot higher, but still higher than the 22.50. The slope that you see here on this position at June expiration is similar to what you see in a diagonal calendar spread or poor man's covered call, meaning once the stock goes above that strike in the poor man's covered call, your short call is quickly going to a delta of 1 because it's nearer to expiration. Even though your long option is deeper in the money, it's lagging at maybe a delta of 0.7 or 0.75, maybe 0.8. But that's why this slope comes off, because at expiration, the delta of your sold option is going to 0 or 1. And as it goes higher, you're losing more on the buyback cost of this call than you're gaining on your leap call that's not at a 1 delta. Similar with the Married Put. I've got a stock with a delta of 1 and a put at this point maybe a delta of about 0.5 or 0.6. And it's lowering and lowering as the stock moves up, but the call is still going to a delta of 1. So I'm not making as much on the stock as I'm losing on the value of the call. So Mike's question was, if I entered this structure and mistimed it, something happened, buyout rumor or some early earnings positive news came out and the stock gaps up to 24. And he says, what happens if the stock is called away by the covered call? Okay, well, number one, in the blueprint, if we discussed that if my plan is to hold this long term and continue to sell income against it, just as we would with a covered call, I'd roll this call. I'd apply income method number 2. Another alternative is I could just let the stock be assigned and try to get back in the stock via income method number 7. It's another way to re-enter the position that's talked about in the blueprint. I'm still holding the long put, but I might use income method number 7 to do that. Or if it's just, let's say I got faked out, Mike. Let's say today was expiration of my call option and it was at 22.46, 22.40 nearing the close. I didn't roll this call out to next month to the 22.50 strike or to the 25 strike. I'm just sitting here with this 22.50 strike, and I look at the after hours trading, and the last 10 minutes after hours, it jumped up to 22.75. Okay, I got assigned. Well, come Monday, the stock opens at 22.80. Well, if I like the stock and I wanted to continue the trade, I might just buy it back. In that case, I could do that too. That's also discussed in the blueprint, I think in the appendix situation. But within each chapter of the blueprint, where we talk about each of the various income methods, what's also talked about is management of that income method, what to do if X or Y. And blueprint owners also see that in some of those members-only webinars. When you log into RadioActive Trading as a blueprint owner, we saw that members-only content there. There's discussions of that one we saw was income method number 4 and managing income method number 1 and number 6. But yes, if I got assigned because an unexpected move happened, I have ways to get back in the position. Or if I hit my goals, Mike, I might just sell the put, take the profit on that RadioActive profit machine, run the search on power options, and find a new trade that I'm interested in getting into. I think I still saw GPK in here a couple days ago, but yeah, we saw Ashland last week. SMCI was in there last week, in the 2 weeks before. Funco dropped out, and that third one I was looking at that we discussed last week or the week before, I can't remember which one that was. It was a stock around this price, $45, $50 stock. We were talking about Ashland, SMCI, and that other one that I can't remember what it was. And yeah, I remembered seeing GPK a month ago, actually, more towards the end of April than the middle of April when we looked at it. Okay, Mike? So that's what you can take a look at there as well. On the search tool for potential positions. But yes, Mike, that's all discussed in the blueprint on managing and so forth, okay? Okay, we're going to move on here. Fernando says, is there a way to have a Married Put Theta Positive? Not not a married put. Okay, what do I mean by that? Well, a married put, you've got a negative theta on an asset you purchased, and you've got no theta on the stock. So by definition, I'm sorry, that's the wrong one. Highlighted right the first time. By definition, I'm always going to be losing theta in just a true married put structure. But if, I don't even know what the theta is on this one, but keep in mind, because the proper structure, Fernando, as you know, we're out 150 days or more out in time, following the 3 core principles of radioactive trading, again discussed in the blueprint there. Yes, I know I'm putting this in at 60 cents, but that was to show what it was when the stock was up at 22.10 near the end of April if we were selling the May series. So I'm putting in the 60 cents here. All right. And let's see here. There you go. It's positive theta, isn't it? So I sold the 22.5 strike call. Yeah, it's really close to the vest here. I don't know if I do that. I might sell the 25. But my theta decay here is a positive 0.0282. The put is a 0.0069. So I'm at a positive theta. The negative theta here is showing for all the other positions I have open. But this would be a positive theta structure with income method number 1. Probably with income method number 6, I could do it too, and still be a positive theta in that case. But by definition, Fernando, what's a married put? Stock plus put combination of any kind. That by itself will always be negative theta because we bought an option that has a negative theta. That's where the income method comes in to put you in a positive theta position as we go forward to June expiration, 14 days away. I'm still thinking it's mid-May. So anyway, that's how you can get them to be. That's where the income methods come in. Does it leave the upside open though? No, just like a long call. If I buy a call option, I've got negative theta because I bought it. Could I get a positive theta call? Well, now I've got to start combining selling a call against it, but now I don't have positive upside. Same thing here with income method number 1 on the married put. Selling any covered call, it does cap that upside. There are income methods to use that leave the upside open and get premium, which might also put you theta positive. Well, that'd be income method number 6, of course, Fernando. We've talked about that before. But as a structure, as you noticed, as you saw it, Fernando, right off the bat, there's no way to have it theta positive by definition. Buying a stock and buying a put or buying an option or long one option in just the married put structure, it's always going to be negative theta. It's always going to be losing a slow time decay to begin with. In those last 60 days, we're going to start to see more of that rapid time decay, Fernando, against us. Okay? All right. And we do have a follow-up question here that we'll put in with Fernando's discussion. This comes up a lot, and I always like to answer this question because it's very easy to answer. And this is going to help me go into another question too. So I'm glad you brought this up, Victor. Victor comments and says, how do we consider IV when opening or managing an RPM, or do we care at all? Great question. And there are 2 things that you can see here. This is the standard radioactive default search sorted by earnings per share growth. That's the preferred one we have. The other default is sorted by risk. So you'd see the same stocks, it would just be opposite order because the lowest risk would appear on the, actually you'd see the same stock, but you might see different strikes that have the lowest maximum risk. But what I've added onto this field, Victor, is the delta column here and the implied volatility. Because we usually get a question that comes in that says, well, when you're structuring the married put for this best risk you prefer, what delta do you look at? I don't. I'm not searching for delta at all. Let me leave the drawing there and scroll down. What we're looking for is the controlled risk we want, and I might make changes to this based on my personal preference. I don't like to take a risk really above 8 or 8.5%, so I'll change that. I'll change the stock price. The default stock price is between 9 and 200. Now I'm not usually going above 110, 120 when I open a married put. Usually it's 85 to 90, but as the portfolio grows, you can buy higher price stocks. But anyway, what options criteria are we using? We're keeping it to our controlled risk function, not going more than 20% in the money, reasonable bid-ask spread on stocks that are moving in the trend that we want with a reasonable volatility. I don't want zero volatility. At times, I will go to a position, Victor, in uncertain markets, a touchstone, I like to call it. I might trade Johnson & Johnson Kraft Heinz, sort of McDonald's, bellwether stocks like that might not appear in this search because they normally have a stock volatility lower than 0.25. Dividend paying stocks that are large cap can still be good positions, especially after a market downturn, because they usually tend to recover quickly and they usually lose less to begin with. And they pay a dividend, which can help the radioactive trade. I was not screening by anything for implied volatility, no restricted range, only the stock volatility above 0.25, not screening for delta at all, but we are looking for strikes 1 to 5% in the money. What do we see here? Because of the stocks we're looking for and the criteria we want, the delta is limited. The lowest is 0.48, and I think the highest I'm seeing is 0.62. We could just call it 0.5 to 0.6, but even if we called it 0.5 to 0.65, that's still a pretty restrictive delta. But I'm not even screening for it. Check out the implied volatilities. A little bit wider range. Here we're going from 0.250, I think is my lowest, to 0.6808, which naturally has the highest risk because of the highest implied volatility. But still, if you think about it, that's pretty wide, but it's not too wide. The average implied volatility right now, I think, is at 0.9. So we're well below the average implied volatility. The one thing I do look for, Victor, when opening a new married put position, and it's not on this search, because again, this isn't my search, is I tend to look for a percent implied volatility range below 70. What does that mean? That means there were some other positions here that had an 89% implied volatility range. I thought M-phase was higher, but it wasn't one of them. What I'm looking for here is I don't want to buy a put that's necessarily at the upper range of its implied volatility. Let's take that out and see what those other ones were. And sometimes it has to be taken with a grain of salt, Victor. But the percent implied volatility range is showing us where the option's implied volatility is now compared to where it has been over the life of the option. Here's one at 89, and the super microcomputer, the one I was considering a week or two ago, is at 88. That makes a lot of sense, doesn't it? Why is that relatively important? Let's take a look. We're going to go to the option research here. Okay. And you see a spike in implied volatility. What's my total range? Oh, that doesn't count. 0 to 5953. But seeing here that we are down to implied volatility of 0.37, 0.35, and we're up here at 0.53. Why would I consider this at all, Victor? This happened to me once. El Paso, at the time, it was El Paso Pipeline LLP, years and years and years ago. And this position looked great, and it had a good controlled risk of 5.3% or something along those lines. And at a time, just like now, the oil companies were doing pretty well. And the stock was in discussion with Brazil. They're waiting for approval of lease rights to wells in Brazil or somewhere else in South America. I'm pretty sure it was Brazil. And it would double essentially the field size that they had to produce on, or to explore, or I should say, for this El Paso pipelines. And I didn't look at it at this time. The implied volatility seemed nominal to me, a little bit high, but that was helping with the call premiums. I was able to sell a call against it for juicy premium, Victor. But what happened? About a month later, Brazil denied them the foreign land lease for exploratory wells in Brazil. The stock didn't move much. It was kind of already priced in. It was, I think, a $35, $38 stock, and it fell about $1.50 to $2. Significant, but not great. All of a sudden, I noticed my put that was worth about $5. I'd paid $6.80 for it. It was worth $6.40 the day before, just a little bit lower because the stock had moved up. It suddenly dropped to a price of $4.10. The implied volatility went from 0.55 to 0.25. Implied volatility cut the intrinsic value in half. Why was that important? Well, remember, I paid that money into the position, into the higher implied volatility. The implied volatility collapse happened. The extrinsic value was worth about half of what I paid. Now, even as the stock continued to go back up, there's no premiums in the calls, and I can't effectively use income method number 3, income method number 4, or really income method number 9, those ones to manipulate the put option, because I lost half of the value because of an implied volatility decrease. I was already $2 lost behind the 8 ball from that drop from whatever it was, 640 down to 410. And I had to try to make that back with calls. And then eventually I just said, this is not worth it. I'm too far behind because of that collapse. Now I know better. And that's why I start using that percent IV range. But a lot of the questions that you ask, maybe what theta do you look for in your married put preferred structure? What delta, what implied volatility? We're not looking for those, but because of the proper structure and the types of stocks we're looking for, you're already filtering by delta, and you're going to see a very good range of implied volatility. And this leads me to another point. Investors will ask, well, I really like such and such stock that has a high implied volatility. Can I trade a married put on it? The answer is yes, but you have to do one of two things. If you want the single digit risk on something that has a higher volatility, you're either going to have to go deeper in the money beyond the range that we like to look for a married put structure on the stocks we prefer, or you're going to have to accept that still going 2 to 3 strikes in the money, you're going to be taking a 14, 15, 16% risk on a stock that you're bullish on. Okay, that's the trade-off. I think there is a webinar on that. Let's try to take a look here. I don't know if I called it Married Puts and IV. Let's just do the search for married puts. Why use a married put? Short-term married puts. Oh, this doesn't do the order I like. Puts on high. No. I'm sorry. I'm not going to spend too much time scrolling this. There is a webinar we did within the last year. Married puts on high implied volatility or high implied volatility married put positions. I'll try to find that later. I don't like using this search because it's not, I'm logged in, but I'm technically not. I'm in the different view. I'm not in the creator view in that case. So I'll try to find that a little bit later, but that's the trade-off with looking for high implied volatility. And where I also wanted to go with this is, oops, sorry, folks, is a question came in. I don't have it on my notes here. I thought I printed it out, but I didn't. There's a gentleman who asked a question at the end of one of the webinars, either last week or the week before. I go through all the comments and everything, and I do occasional presentations on those, but I usually write them down to do future presentations. I can't find it, and I think it was Harry. No, it wasn't Harry. It was the other gentleman who had asked a question last week, but in any case, he had asked, what are your thoughts on using the married puts on natural resource stocks? The blueprint, as we mentioned, discusses the proper structure we prefer that can really work for any stock. But if it's a high volatility stock, you have to expect more risk. If it's a lower volatility stock, IBM or something, you'll get a lower risk. But you might have a harder time doing the income methods, but it's all relative. If I open a good position on IBM that only has a 4% risk out to December, I still have time to generate that premium to get that position a bulletproof status. And if the stock does what I want, although it moves slower than most other stocks, but it's still strong, a bellwether stock, as we mentioned, I may still be able to adjust the put to get the bulletproof status as well. But the blueprint discusses the structure, and it discusses the stocks we like to use and why the search criteria is set up that way. The married put structure, as you can see, just by the basic profit and loss profile, will work on any stock that you're bullish on. It's just that you have to take into account that if it's a higher volatility stock, you're going to be starting off with a higher percentage at risk. That's just the nature of the trade. You're either going to have to go deeper in the money, which may lower your expectancy of profit to have the single digit risk, or accept that going in the structure that we like, not going more than 20% in the money or so, you're going to have a much higher risk. That's just the trade-off that you're going to have. So the question that was asked, what are your thoughts on the married puts on natural resource stocks, is the same as anything else. The married put is a great way to protect your downside, protect your investment. It's not trading against yourself. It's insurance policy for your investment, tens and 20 to thousands of dollars into stock positions that you're guaranteeing you can't lose more than 5, 6, 7% on. This is just what we prefer to use. How Kurt used the structure. Ernie adjusted the criteria when we partnered up with Kurt back in 2007 and 2008, and what has worked for us. And a couple times I have done these as well and moved it in that case, looked at the criteria compared to, say, different stock lists, looking at technicals and fundamentals, and this structure usually gives us the best performing stocks when I do those tests. Okay, so the idea here is that, let me just go to no lists. I don't know if I have a good sector or industry. I don't think there's one for just natural resources, but I might just use something. Let's see, non-metallic. What was that? Non-metallic mineral mining. Why not? Let's see if that gives us anything. Yeah, I didn't think so. But that's okay. It's just let's look at copper. I don't even know if this was updated recently, but that's okay. Okay. Why don't I just do the whole kit and caboodle? Let's just do basic materials. Here we go. So, not all of these are the same type of natural resources, but some of them here are. There's that Ashland again. I should have just opened that RPM the other day. I was thinking about it, but it's higher than I normally do. Huntsman Eastman Chemical and Chemours, that's been coming up a lot in the search too. But in any case, it's the structure that's important to put the odds on your side of controlled risk guaranteed better than a stop order. And it can work on any stock that you're bullish on with the proper structure. Doesn't have to be directly from our search. Any stock that you feel is neutral to bullish and you can get the controlled risk you want, or maybe a little bit higher if you don't want to go too deep in the money, that's fine too. So you can do it on natural resources. You can do it on mining stocks. You can do it on basically any stock. It doesn't have to be our preferred stock. The blueprint teaches how to do this really in any structure. I have some customers where 50% of their Married Put portfolio is just SPY. And they just keep rolling it out and rolling it out and rolling it out. When they, they're about a year and a half out in time, when they get to about 4 months to the expiration, maybe it's a January series, they'll just roll it out to the next January series and just continue the trade in that fashion. So it can be used on any type of security. It's just the safety structure, the best structure to use in that format as well. Okay, Fernando does add, in the married puts, when I buy the put, I choose the largest open interest in a strike and a delta near 0.7. He says, if you take a put and a call at 0.7 delta and look on the chain to the extrinsic value, I've seen that the time value in the call is always more expensive than the time value in the put. That would depend also on market conditions, Fernando. I've seen lots of times where, let's just take that weird one, SMCI that I was talking about, that I was looking at, that had that higher implied volatility range. And let's go to what we do, 168 days out in time. And I need delta, which I have, and percent in the money, which I have, and I've asked time value. Okay. So the delta of 0.7 on the put is going to be 0.762, the 21 strike. My time value is 261 or 4.8%. My call side, it's 219 and 4% for the 0.70. Okay, it's not quite 0.76, but they're close. So in this case, the put has the higher. Was that what you said, though? You've always seen the time value in the call is always more expensive than the put. Now, I don't know if you're talking about the same strike, though, of course. I mean, the point, if you're comparing 0.7 delta here on the put to the 0.3 or 0.24 delta here, the time value is 310 in this case. So maybe that's what you're referring to. You're, I don't know if you're looking at 0.7. So want to be as, and you just go on to say on it. So if you want to be long, it's always more convenient to use a synthetic call, married put, than using a 0.7 delta call. Yeah, in this case, it wouldn't be, right? In this case, it's the opposite. But I know what you're saying. A lot of times I see that too. And it usually comes due to the wide bid-ask spread of the in-the-money calls. Although the in-the-money puts, this one has a pretty wide bid-ask spread also for a price on that as well. But no, I see what you're saying. No, it's always good to compare. But again, remember, if you go the long call route, as you know, Fernando, this one here actually has the lower time value than the in-the-money put. But in most cases, I see the same thing. Let's go. What was that other one I was looking at? Ashland. And, oh, January's good. Perfect. My 0.7 call. 0.713, the 95 strike. Time value of 757. That's on the ask price. And my put. 0.742. 463. Wow. Absolutely. There you go. This would be much better to go with the put with the 0.7 delta, 757 on the call, and I just had it 463 for the 0.7 delta on the put. So absolutely, I'd be going with the put in the stock every day, like you said, rather than using the 0.7 call with that higher time value in this scenario. No doubt. But it depends on the stock and it depends on market conditions. We saw SMCI was the exact opposite in that case. But a lot of times you're absolutely right. I usually do see comparatively a lower time value in that case. Now, well, we're talking about the same strike, right? We were talking about a 0.7 call delta versus a 0.7 put delta, and comparing the range in the money for both of those. Time value on the put being lower is what Fernando was saying, and we saw that example, but we saw one that wasn't in that case as well. We're not talking about the sort of parity trade of looking at the 0.3 delta long call versus the 0.7 put. In that scenario, we're looking at the in the money call versus the in the money put, and that's what we're talking about there.